$100,000 in annual bonus just disappeared from your comp projection. And Alphabet's earnings miss is the first signal it's real. You probably think megacap earnings misses are a market problem, not a paycheck problem. Your tech comp is locked in contractually, right? Here's the gap. Goldman Sachs paycheck recession research shows that when sector-wide earnings pressure hits megacaps, bonus pools and equity refresh cycles reset downward 12-24 months later. And BLS data proves it happened after 2022-2023. For $400K household with $100K in annual bonus or RSU comp, that's $15K, $25K, erased plus the opportunity cost of holding illiquid RSUs during a sector downturn. By the end of this video, you'll know the 3 specific comp structures at risk, the timeline for when companies reset them, and why timing your equity liquidity now could save you $20K, $40K over the next 18 months. Alphabet just missed earnings guidance. That's the headline. But here's what Wall Street's missing. It's the first domino in Goldman's paycheck recession thesis. Goldman Sachs chief economist recently warned that wage growth will decelerate sector-wide as earnings pressure forces companies to reset bonus pools. This isn't speculation. BLS employment cost index data shows that in the 12 months after the 2022 tech layoff wave, bonus pools contracted 15-25% for high-income earners, and wage growth lagged the broad economy by 220 basis points. Alphabet's earnings miss today means that cycle is starting again, right now. And if you're sitting in a comp review cycle within the next 90 days, you're at ground zero. Here's the math that matters to you. If you're a high-income tech worker earning $300K, $500K annually, your total comp typically breaks into 3 buckets. Base salary locked, usually 60-70% of total comp. Annual bonus, typically 20-30%, highly variable with company earnings. And equity refresh grants or RSU vesting, 10-20%, sensitive to stock price and company performance guidance. When earnings guidance falls, like Alphabet just did, companies don't cut base salary first. They reset bonus pools in the next comp cycle, typically 12-18 months out. Then equity refresh rates compress. A 15-20% reset on bonus pool and equity refresh. That's $15K, $25K gone from $400K household income. For a $500K earner, it's $25K, $50K. For a $600K earner, we're looking at $30K, $60K, erased from projected comp over 2 years. The timeline is critical, and this is where most people miss the window. Alphabet reported earnings in late January. Comp cycles at megacaps reset in Q1 and Q3. That's April, June, and September, October. If forward guidance deteriorates further in Q1 2025, bonus pool resets for next fiscal year start in April, May. You have 60-90 days to decide. Do I accelerate equity liquidity now, or wait and risk holding RSUs while my company cuts refresh rates? Most high-income professionals wait. That costs them. After 2022, tech workers who held RSUs through bonus pool resets lost 12-18% of household income in opportunity cost, not from the RSU price drop, but from compressed refresh rates hitting 6 months after they expected. And that's the hidden cost nobody talks about. So here's the mechanism. Earnings miss in January, right arrow board signals downward guidance in March earnings, call right arrow CFO, and people team model lower bonus pools in April, right arrow HR, communicates reduced targets in May comp reviews, right arrow equity refresh rates compress by June, July. If you haven't accelerated RSU sales by March or April, you're selling into a repriced market 6 months later, while your new refresh rates are already 15-20% lower. Now, the 3 comp structures that reset first. 1. Annual bonus pools. These reset fastest because they're annual and tied directly to company-wide earnings targets. 2. Equity refresh rates. These follow 6-9 months after bonus resets because companies model them into longer-term planning. 3. Sign-on equity for new hires or promotions. This resets last but also deepest, sometimes 25-30% compression. If you're planning a promotion in Q2 or Q3, your equity grant could be materially smaller than what your manager promised in Q4. Here's the open loop I promised. I'll show you the exact signals to watch for when your company's bonus pool is about to reset, and how to model your personal income cliff 12 months before it hits. So what's the one-sentence action? If your company's earnings guidance is flat or negative over the next 12 months, and you have unvested RSUs or pending bonus decisions, model a 15-20% reset on bonus pool and equity refresh in your next comp cycle. If that $15K, $25K hit would change your financial decision, early home purchase, refinance, major expense timing, you have 60-90 days to decide on equity acceleration or bonus deferral before comp cycles reset downward. The biggest takeaway: Alphabet's earnings miss isn't just tech sector news. It's a signal that Goldman's paycheck recession thesis is live, and bonus pool resets are 12-18 months out. If you're a high-income earner in tech or finance, you need to act before comp cycles close in April. Your paycheck depends on it. If this changed how you're thinking about your equity comp, subscribe. I'm covering paycheck risk modeling for six-figure earners in the next video, dropping Friday. Ring the bell so you don't miss it. What's your biggest takeaway? Are you planning to accelerate any equity decisions or hold? Comment below.